We are taught that the International Monetary Fund rescued Thailand during the 1997 Asian financial crisis, that the $17 billion emergency loan prevented total economic collapse and restored stability to the region, that without IMF intervention, things would have been much worse. But this is the version written for people who never looked at what the IMF actually required in exchange for that money. The truth is that the IMF's $17 billion loan didn't rescue Thailand, it destroyed it. The conditions attached to the loan forced policies that turned a currency crisis into an economic catastrophe. Unemployment exploded from 2% to 12%. GDP contracted by 10% in a single year. 2 million people fell into poverty. The middle class was wiped out. And the crisis didn't stop at Thailand's borders. The IMF's template spread the contagion to Indonesia, South Korea, Malaysia, and the Philippines. 50 million people across Asia lost their jobs. Governments fell. Riots killed thousands. An entire generation's economic progress was erased. This is the story of how the IMF destroyed Asia to protect Western creditors, and why the same playbook is being used on Sri Lanka and Pakistan today. In 1997, Thailand was celebrated as an economic miracle. The Thai economy had grown at 8 to 9% annually for a decade. Bangkok's skyline was filled with construction cranes. Foreign investment poured in. The middle class was expanding. Thailand was seen as proof that developing countries could achieve sustained growth through market-oriented reforms and integration with the global economy. The transformation had been remarkable. In 1987, Thailand was still primarily agricultural, with per capita income of just $1,000. By 1996, it had become a manufacturing hub with per capita income of $3,000. Poverty rates had fallen from 30% to 11%. Literacy approached 95%. Life expectancy had risen to 70 years. Bangkok had transformed from a sleepy provincial capital into a modern metropolis with shopping malls, elevated highways, and a newly constructed mass transit system. The World Bank called Thailand an East Asian tiger, grouping it with South Korea, Taiwan, Singapore, and Hong Kong as examples of successful development. International investors poured money into Thai stocks and bonds. Tourism exploded. 8 million visitors annually by 1996. Drawn by beaches, temples, and the promise of exotic adventure, Thai cuisine became fashionable in Western capitals. Bangkok was seen as the next Singapore. The foundation of this miracle was the Thai baht, which had been pegged to the US dollar at 25 baht per dollar since 1984. The peg provided stability. It made Thailand an attractive destination for foreign investment. If you were a Japanese or American investor, you could invest in Thailand knowing the exchange rate wouldn't change. You could borrow dollars at low interest rates, convert them to baht, invest in Thai assets, and be confident you could convert back to dollars at the same rate. This stability created a massive inflow of foreign capital. Between 1990 and 1996, Thailand borrowed over $100 billion from foreign lenders. Banks in Tokyo, New York, and Frankfurt lent eagerly. Thai companies borrowed to build factories, office towers, and condominiums. Thai banks borrowed to lend to these companies. The debt was denominated in dollars and yen, but everyone assumed the baht peg was permanent. The problem was that the baht peg was not sustainable. To maintain the peg, the Bank of Thailand had to ensure that demand for baht roughly equaled supply. But by 1996, the situation was becoming unstable. Thailand was running a current account deficit of 8% of GDP. The country was importing far more than it exported. The trade deficit had to be financed by foreign borrowing. At the same time, the US dollar was strengthening because the baht was pegged to the dollar. When the dollar rose, the baht rose with it. This made Thai exports more expensive and less competitive. Export growth slowed. The current account deficit widened. More borrowing was required to maintain the peg. Currency speculators began to notice. If Thailand couldn't maintain the peg, the baht would have to devalue. Anyone who bet against the baht before the devaluation could make enormous profits. In early 1997, hedge funds led by George Soros and others began shorting the baht. They borrowed baht, sold it for dollars, and waited for the devaluation. The Bank of Thailand tried to defend the peg. They spent billions of dollars from their foreign reserves buying baht to prop up the price, but the reserves were limited. By May 1997, the Bank of Thailand had spent $30 billion defending the currency. The reserves were nearly exhausted. On July 2, 1997, the Bank of Thailand announced it could no longer maintain the peg. The baht would float. Within hours, the baht lost 20% of its value against the dollar. By the end of the year, it had fallen 50%. From 25 baht per dollar to over 50 baht per dollar, the impact was immediate and catastrophic. Every Thai company that had borrowed in dollars suddenly owed twice as much in baht terms. A company that owed $100 million had owed to 5 billion baht before the devaluation. After the devaluation, that same $100 million debt was worth 5 billion baht. The debt had doubled in local currency terms. Most Thai companies couldn't pay. They defaulted. Banks that had lent to these companies faced massive losses. The financial system was on the verge of collapse. Foreign investors panicked and pulled their money out of Thailand. The stock market crashed. Real estate prices fell 40%. Construction projects were abandoned halfway through completion. The skyline of Bangkok became filled with unfinished buildings, monuments to the boom that had turned into a bust. The Thai government turned to the International Monetary Fund for emergency assistance. On August 11, 1997, the IMF announced a $17.2 billion rescue package for Thailand, the largest IMF loan in history at that time. But the loan came with conditions, extensive, detailed, and brutal conditions. The IMF's diagnosis was that Thailand's crisis was caused by fiscal irresponsibility, bad banking practices, and structural weaknesses in the economy. The solution, according to the IMF, was austerity, high interest rates, and structural reforms. Thailand was required to, first, implement fiscal austerity. The government budget had to be cut dramatically. The target was a fiscal surplus of 1% of GDP, a swing of 3% from the existing deficit. This meant cutting government spending by hundreds of billions of baht. Public spending on infrastructure, education, and health was slashed. Government employees were laid off. Subsidies for fuel, food, and utilities were eliminated. Public hospitals saw their budgets cut by 30%. Schools in rural areas closed. Infrastructure projects were cancelled mid-construction. Second, raise interest rates to defend the currency and restore confidence. The Bank of Thailand raised rates from 10% to 25%. The logic was that high rates would make holding baht attractive, encouraging capital to stay in the country rather than flee. But the effect was to destroy businesses that were already struggling with double debt burdens. A company borrowing to finance inventory suddenly faced interest costs 2.5 times higher than before. Third, close insolvent financial institutions. 56 finance companies were shut down immediately, representing 40% of the financial system. The IMF argued these institutions were badly managed and needed to be closed to restore confidence. But the closures triggered bank runs as depositors rushed to withdraw their money before their banks were closed too. Lines formed outside banks as people tried to get their savings out. The financial panic intensified rather than subsided. Fourth, open the financial sector to foreign ownership. The previous limit on foreign ownership of Thai banks, 49%, was removed. Foreign banks and investors were allowed to buy Thai financial institutions at fire sale prices. Within 2 years, most of Thailand's banking sector was the assets were acquired for a fraction of their pre-crisis value. Fifth, implement structural reforms including labor market deregulation, privatization of state enterprises, and reduction of government intervention in the economy. State-owned utilities were to be privatized. Labor protections were to be weakened. The Thai government was required to pass legislation making it easier to fire workers and reducing severance requirements. The IMF called this a comprehensive reform package, designed to restore confidence and lay the foundation for sustainable growth. In practice, it was a recipe for economic destruction. The austerity measures made the recession worse. When the government cut spending, demand in the economy fell further. Businesses had fewer customers. They laid off workers, unemployment rose, consumer spending fell. The economy spiraled downward. The high interest rates destroyed what was left of the private sector. Companies that were struggling with double debt burdens now faced interest rates of 25%. They couldn't borrow to stay in business. They couldn't refinance their debts. They went bankrupt. The bankruptcy rate in 1998 was 10 times higher than in 1996. The closure of 56 finance companies triggered a credit crunch. Small and medium businesses that depended on these institutions for loans suddenly had no access to credit. They couldn't pay suppliers. They couldn't make payroll. They shut down. The unemployment rate, which had been 2% before the crisis, reached 12% by 1998. 6 million people lost their jobs. The poverty rate doubled. In the countryside, families that had sent their children to work in Bangkok factories saw those children return home with no jobs and no prospects. The social impact was devastating. Suicides increased. Domestic violence rose. School enrollment dropped as families could no longer afford fees. Malnutrition rates among children spiked. The progress of a decade was erased in 18 months. But the worst part was that the IMF's policies weren't designed to help Thailand. They were designed to ensure that foreign creditors got paid. The austerity and high interest rates served one primary purpose: to generate a current account surplus. If Thailand imported less and exported more, it would earn dollars. Those dollars could be used to service the foreign debt. The pain inflicted on the Thai economy was the mechanism for extracting resources to pay Western banks. The structural reforms served a different purpose: to open Thailand's economy to foreign acquisition. When Thai banks and companies were forced into bankruptcy, they were sold to foreign investors at a fraction of their value. JP Morgan bought Thai banks, GE bought Thai infrastructure, Western companies acquired Thai assets for pennies on the dollar. The IMF loan itself was largely a transfer from Thai taxpayers to foreign creditors. The $17 billion didn't go to unemployed Thai workers or bankrupt Thai businesses. It went to repay foreign banks that had lent recklessly during the boom. The debt was socialized. Thai citizens would spend the next decade repaying a loan that was used to bail out foreign investors, and the crisis didn't stay in Thailand. The IMF's template was applied across Asia with the same results. Indonesia was next. The rupiah collapsed in August 1997, falling from 2,400 per dollar to over 15,000 per dollar by January 1998. The IMF provided a $43 billion package, the largest in history at that time. The conditions were even harsher than Thailand's. The Indonesian government was required to eliminate subsidies on basic necessities. Food prices doubled overnight. Fuel prices tripled. For a country where 40% of the population lived on less than $2 per day, this was catastrophic. People couldn't afford rice. They couldn't afford to cook the rice they managed to buy. Riots erupted across Jakarta and other cities in May 1998. Mobs attacked shops owned by ethnic Chinese, who were perceived as wealthy. Buildings were burned. Over 1,200 people were killed in the violence. The military fired on protesters. Bodies filled the streets. The capital was under curfew for weeks. President Suharto, who had ruled Indonesia for 32 years with American support, tried to resist some of the IMF's demands, but the IMF and the US Treasury made clear that without full compliance, no money would be released. Suharto had no choice. He signed the agreement. But the riots continued. On May 21, 1998, Suharto resigned. He fled the presidential palace by helicopter as mobs approached. The economic cost was staggering. The Indonesian economy contracted by 13.1% in 1998, the worst peacetime economic collapse in modern history. 20 million people lost their jobs. The poverty rate doubled from 11% to 24%. Infant mortality increased. School enrollment fell. Indonesia, which had been seen as a development success story, was suddenly back to 1980s levels of poverty. The rupiah eventually stabilized at around 10,000 per dollar, a permanent 75% devaluation. Every company and bank that had borrowed in dollars during the boom years was bankrupted. The entire corporate sector had to be restructured. It took a decade for Indonesia's economy to recover to its 1996 level. South Korea fell in November 1997. The won lost 50% of its value in a matter of weeks. The IMF provided $57 billion, the largest rescue package in IMF history, surpassing even Indonesia's. The conditions were severe. Interest rates were raised to 30%. Government spending was cut. Banks were closed. Labor laws were reformed to make it easier to fire workers. The social impact was immediate. Unemployment, which had been 2% before the crisis, reached 8% by mid-1998. In a society where lifetime employment had been the norm, mass layoffs were traumatic. Middle-class families that had never experienced unemployment suddenly had no income. Suicides spiked. The divorce rate increased. The humiliation of economic failure in a Confucian society where success is deeply tied to honor was profound. The Chaebols, the massive family-controlled conglomerates that dominated the Korean economy, were the primary targets of the IMF's structural reforms. Daewoo, one of Korea's largest companies with interests in automobiles, electronics, construction, and finance, collapsed in 1999 with $80 billion in debt. Hyundai nearly failed. Samsung survived only through massive restructuring and asset sales, but Korea's experience differed from Thailand's in one crucial respect. Korea recovered faster. By 2001, the economy was growing again. By 2003, GDP had surpassed pre-crisis levels. The recovery was aided by aggressive monetary expansion once the immediate crisis passed, by maintaining social spending to protect the unemployed, and by Korean companies' ability to export their way out of the crisis. Malaysia, the Philippines, and even Hong Kong were affected by the contagion. Currency speculators attacked the Malaysian ringgit, the Philippine peso, and the Hong Kong dollar. Stock markets across the region crashed simultaneously. The Hong Kong stock market fell 50% in 4 months, despite the Hong Kong dollar peg holding. Across Asia, currencies fell, stock markets crashed, and economies contracted. The total cost was estimated at $600 billion in lost output. 50 million people lost their jobs. Entire industries disappeared. The Asian economic miracle, which had been the subject of countless academic papers and business books, was declared over. Books that had celebrated Asian values and Asian capitalism were amended. The IMF claimed the crisis proved that Asian economies needed more liberal reforms, more deregulation, and more openness to foreign capital. The reality was the opposite. The crisis was caused by the premature liberalization the IMF had encouraged in the first place. Countries that had opened their financial systems to short-term capital flows were vulnerable to speculative attacks. When the attacks came, the IMF's response made everything worse. The one country that rejected the IMF's prescription was Malaysia. Prime Minister Mahathir Mohamad refused IMF assistance. Instead, Malaysia imposed capital controls in September 1998, preventing money from leaving the country. They pegged the ringgit at 3.80 to the dollar. They maintained government spending to support the economy. They recapitalized banks without closing them. They protected employment through public works programs. The IMF and Western economists predicted disaster. The Economist magazine called Mahathir's policies economic suicide. The Wall Street Journal said capital controls would destroy Malaysia's economy and scare away investors permanently. The US Treasury warned that Malaysia would become an international pariah, but the opposite happened. Malaysia's recession was shorter and shallower than Thailand's or Indonesia's. GDP contracted only 7.4% in 1998, compared to 10% in Thailand and 13% in Indonesia. The recovery was faster. By 1999, Malaysia was growing at 6%. By 2000, the economy had fully recovered. Foreign investment returned despite the capital controls. Unemployment remained under 4%. The lesson was clear. The IMF's policies didn't help. They made crises worse. Countries that followed the IMF playbook suffered more and longer. Countries that rejected it recovered faster. The lesson was clear. The IMF's policies didn't help. They made crises worse. Countries that followed the IMF playbook suffered more and longer. Countries that rejected it recovered faster. But the IMF never acknowledged this. The institution continued to insist that austerity, high interest rates, and structural reforms were the only solution to financial crises. The playbook remained unchanged. Today, the same playbook is being used on Sri Lanka and Pakistan. Sri Lanka's crisis in 2022 followed the exact pattern of Thailand 1997. The rupee collapsed from 200 per dollar to over 360 per dollar. Foreign reserves, which had been $7.6 billion in 2019, fell to under $2 billion by early 2022. The government couldn't pay for imports of fuel, food, and medicine. Fuel shortages paralyzed the economy. People waited in lines for days to get gasoline. Hospitals ran out of essential medicines. Power outages lasted 12 hours per day. Protests erupted in Colombo and across the country. Hundreds of thousands took to the streets demanding the government resign. On July 9, 2022, protesters stormed the presidential palace. President Gotabaya Rajapaksa fled by military jet. The government fell. The IMF stepped in with a $3 billion loan in March 2023. The conditions were familiar, identical to the 1997 playbook. Fiscal austerity requiring government spending cuts. Higher taxes on already impoverished citizens. Subsidy removal on fuel and electricity. Electricity prices doubled. Fuel prices tripled. The currency was allowed to float, losing another 30% of its value within months. The result was predictable and devastating. GDP contracted by 8.7% in 2022. The poverty rate, which had been 13% before the crisis, exceeded 25% by 2023. Malnutrition among children increased. School enrollment dropped. The middle class that had emerged during Sri Lanka's growth years was wiped out. The IMF loan didn't rescue Sri Lanka. It ensured that foreign creditors, mostly Chinese banks and Western bondholders, got paid, while Sri Lankan citizens bore the cost. The pattern was Thailand 1997 repeated 25 years later. Pakistan is following the same path. In 2023, Pakistan received its 23rd IMF program. The conditions include eliminating fuel subsidies, raising electricity prices, and devaluing the rupee. Inflation has reached 30%. The currency has lost 50% of its value in 2 years. Millions have fallen into poverty. The pattern is identical to Thailand in 1997. A currency crisis becomes an economic catastrophe because the IMF's conditions prioritize debt repayment over economic recovery. The loan rescues foreign creditors, not the local population. The fundamental problem with the IMF is not incompetence. It is that the institution serves a different purpose than its stated mission. The IMF's stated mission is to promote global economic stability and help countries in crisis. The actual function is to ensure that debts to Western creditors are repaid, regardless of the cost to the debtor country. This is why IMF programs always include the same conditions: austerity to generate a surplus for debt service, high interest rates to attract foreign capital back, structural reforms to open the economy to foreign acquisition. These policies serve creditors, not citizens. Thailand in 1997 was not a failure of IMF policy. It was a success. Foreign banks were repaid. Thai assets were acquired at bargain prices. The Thai economy was restructured to be more open to foreign capital. From the IMF's perspective, the program worked exactly as intended. The cost was borne by the Thai people. 6 million unemployed, 2 million pushed into poverty. A decade of lost growth. An entire generation's economic progress erased. But these costs don't appear in the IMF's assessments. The IMF measures success by whether the loan is repaid and whether the country implements the required reforms. Human suffering is not part of the calculation. This is the true lesson of the 1997 Asian financial crisis. The IMF is not a neutral technocratic institution that helps countries in trouble. It is a mechanism for enforcing creditor claims regardless of the social cost. The $17 billion loan to Thailand was not a rescue. It was a tool for extracting wealth from a crisis-stricken country to protect foreign investors, and the same mechanism is being used today. When Sri Lanka collapses, when Pakistan defaults, when the next currency crisis hits, the IMF will step in with the same playbook: austerity, high interest rates, structural reforms. Foreign creditors will be made whole. The population will pay the price. The IMF didn't destroy Thailand because of mistakes or bad analysis. It destroyed Thailand because that is what the IMF is designed to do. The institution exists to maintain a global economic system where debts must be paid, even if it means destroying economies and impoverishing millions. Thailand learned this lesson in 1997. Malaysia learned it and refused to participate. Sri Lanka and Pakistan are learning it now. The question is whether the next country in crisis will remember what happened in Bangkok in 1997, or whether they will make the same mistake and accept the IMF's help. Those who understand history know that IMF rescue packages don't rescue the people, they rescue the creditors. And the cost of that rescue is measured in millions of lives destroyed. This is Decoded Economics. Subscribe to see the future before it arrives.